At this point, I want to introduce Kenny Burdine, who joins us from our friends to the south at the University of Kentucky. Thank you for being with us, Kenny. We really appreciate it. Kenny grew up in Jasmine County, Kentucky. I hope I said that right, where his family produced tobacco and raised cattle and sheep. He received his BS in agricultural economics in December of 1999 and began working as an extension associate in the Department of Agricultural Economics. He pursued his graduate degrees on a part-time basis, completing his master's in 2003 and his PhD in 2011. Kenny joined the agricultural economics faculty there at the University of Kentucky in 2012 and is currently an associate extension professor in livestock economics. Kenny focuses his extension programming in the areas of livestock marketing, price risk management, and general profitability. He travels extensively and delivers 40 to 60 programs each year directly for livestock producers. His applied research interest is primarily focused on marketing and decision-making for beef, dairy, and forage producers. Kenny also teaches a livestock marketing class on campus, which is taken by 30 to 40 undergraduates each fall. Thank you for being with us, Kenny, and we look forward to your presentation.
Well, thanks a bunch, Ben. I appreciate it. Glad to be with you virtually. And I also want to say certainly thanks to Chris, Diane, and Jason as well for their feedback and input and some of the planning that we all did together on this. And I don't know how many emails Diane and I have swapped over the last couple of weeks, but I'm guessing it's probably upwards of 12 or 15. So thanks to all of them for allowing me to be part of this. So here's kind of the plan for my part of this discussion. This program today is going to really highlight several tools, and they all have merit. And I'm kind of going to be talking between, what Chris covered first, the DMC program, which I'm a huge believer in. That I think should be layer one for everybody. And then after I'm done, Jason's going to talk about the Dairy RP program, which I think probably would be the second thing that I would look at. Specifically, I'm going to focus on livestock gross margin for dairy and a quick overview of futures and options. In some ways, I think LGM is almost kind of the forgotten program that's been out there. So I want to hit it a little bit, and then I'll very, very quickly talk about some futures and options related stuff. One reason why I think it worked well to have the LGM discussion follow the discussion that Chris gave about DMC is because there are some similarities in the two programs. They can almost be a bit confusing at times because of the way that they are similar. So I want to start by just discussing LGM dairy from the frame of reference. How does it compare margin-wise to DMC dairy? So first of all, understand that LGM dairy is an insurance program, where DMC, you would go through the FSA office. It's a government program. LGM dairy is an insurance program. So you would work through an insurance agent that you might have a relationship with, or one that sells, farm type insurance. LGM is going to give you the opportunity to lock in a margin, milk price over feed cost in the future. And I've got lock in parentheses because you're kind of locking it in via the futures market. So you're not locking in your individual margin. You're doing so using futures contracts. The milk price that's used in LGM dairy is class 3 milk futures, which we're all familiar with. And the feed cost is a ration, if you will, using just simply corn and soybean meal futures. Two quick things before I move this slide. There has been a lot of work in the past. I was involved in some several years ago that absolutely established that LGM dairy is an effective risk management tool. It will do a good job lowering margin risk for dairy operations. So it has merit in that sense. Also understand that it is a margin-based insurance. If any of you have crop insurance, you know how crop insurance works. The guarantee that you can set is going to change with the market, between, now and spring. And the same thing with LGM. It's going to evolve with class 3 milk futures as well as corn and soybean meal futures. So the differences in DMC and LGM really fall into 3 broad categories. First of all, there's a milk price difference. Secondly, there's a difference in the way the feed cost component is handled. And LGM, by the way, is customizable, whereas DMC is not. And maybe the most important thing is just understanding the nature of the two programs and how they're very different. One is market-based and one is very, very fixed in nature. So first of all, understand if you look at the DMC margin, which like Chris said, you can lock in up to $9.50 above feed cost. Understand that's based on a very different milk price and feed cost equation. So the DMC program that Chris talked about uses US all milk price as its feed price, which includes all classes of milk, which typically means it's going to be higher than Class 3 milk futures, which is what LGM is based on. So historically, the US all milk price has exceeded Class 3 milk by about $1.50 a hundredweight. So I track something like this on a regular basis, and I'm just simply showing you, by month, a 3 and 5 year average of US all milk price minus Class 3. And it has tended to be lower kind of late summer, around $1 or so. By the time we get into the winter months, it's usually closer to $2, but $1.50 has been a decent estimate for what that difference has been historically. Now, I watched Mark's presentation that he did, I guess, 2 weeks ago, and I thought he did an outstanding job talking about different dairy producer price differentials and then the divergence between Class 3 and Class 4 futures. Class 3 and Class 4 milk, and how that's impacting farm level milk. So I don't want to bypass that discussion at all. It's important to understand that things do change. So I've dropped 2020 on this chart just to show you how different 2020 has been than the previous 5 years. Another way to say this would be if I was using LGM dairy, which is based on Class 3 milk. Class 3 milk is not following near the way that my producer milk check has, which means from a risk perspective, that's a basis risk I've got to keep in mind. So know those things change. Historically, though, pre-2020, I would have said expect about $1.50 difference per hundredweight. Beyond the milk price component, the feed cost equation is different. With LGM, a producer can go in and literally customize and estimate how much corn and how much bean meal they think they feed to produce 100 pounds of milk. So it's customizable. There's minimums and maximums, but they're pretty broad. The DMC program, that feed cost equation is fixed. It does involve corn price and soybean meal price, although they're more like cash prices. There's an alfalfa hay price component, but that is fixed for the life of this farm bill. Now, I want to be very specific and talk about what this actually means from a practical perspective. If you look at LGM dairy margins, and the way that Chris showed you the tool for DMC, I think there's a similar tool for LGM, or you could get a quote from an insurance agent. There's a default feed ration for LGM, and that default feed ration is 28 pounds of corn and 4 pounds of bean meal for 100 pounds of milk produced. So those are some pretty low numbers, okay? Again, they can be changed, but that's what the default is. Now, if I do the exact same thing for DMC, if you work through the quick math, that DMC ration, if I can call it that, is a little over 60 pounds of corn, 14.7 pounds of soybean meal, and 27.4 pounds of alfalfa hay, which means there are 32 more pounds of corn, 10.7 more pounds of soybean meal, and 27.4 more pounds of alfalfa hay in the DMC feed cost equation than the default LGM dairy equation. So I've got to account for both the milk price difference and these feed cost differences if I want to compare the DMC and LGM margins. There's a couple ways to do that. To me, the simplest way to think about it is I'm going to go into LGM, work with my insurance, and I'm going to say, okay, let's start this way. I want to set my LGM corn quantity and soybean meal quantity to exactly match what the DMC margin quantities are. That would be kind of step number one. That's going to more or less fix those two things. Now, the prices will still be different because, again, LGM is futures based. DMC is based on kind of a national corn price and ag prices, and it's based on soybean meal price in Decatur, Illinois. So they're not perfectly the same, but they'll be really close. And understand from a risk perspective, change is what matters. Okay, it's okay if they're a bit different. What really matters is, do they move the same when the market moves? That's kind of step number one. Then I've got to account for the fact that that DMC equation is based on typically a higher milk price in the US all milk price than the LGM, which is class 3. So I got to subtract those two. And then there's no alfalfa hay component in LGM at all. So I've also got to subtract that full value from the margin in DMC. So that is the best and I think the most appropriate way to do it. I want to also give you some rules of thumb based on calculations that I've done. But if I use just kind of a simple, rule of thumb, corn price around $4, alfalfa price around $200, and soybean meal around 250, 300, something like that. Here's a couple of rules that I'm keeping in the back of your mind. For those two margins to be comparable, if I use the default LGM feed ration, okay, which is half a bushel of corn and 4 pounds of bean meal, the LGM margin needs to be about $4.50 to $5 higher to be comparable to DMC. And if I go ahead and do what I suggested early on, and if I fix the quantities of corn and bean meal in LGM the same that they are in DMC, that LGM margin needs to be somewhere in the ballpark of $1.50 to $2 higher to be comparable. Okay, so the real story is here, they're both margin oriented. One is flexible and one is not. But understand that you cannot compare those as apples to apples. You've got to do some calculations. These are some simple rules of thumb for you as you go forward. Perhaps the most important thing to understand is just the very nature of the programs. Understand that LGM dairy is futures-based, it's market-based. What that means is that good times in the dairy sector will give me a chance to lock in good margins via LGM. The reverse of that is also true. I tell my producers at home, if the market conditions suggest that prices are that margins are going to stink in the future, the best I can do through LGM is probably lock in a margin that's going to stink in the future. So it's market-based. It's in no way counter-cyclical, unlike DMC, which actually is. DMC is a bit of a throwback. The margins I can lock in through DMC and the premiums I'm going to pay don't evolve with the market. They're fixed for the life of the farm bill, which goes through 2023. So they're very different in that sense. What it means is LGM is generally going to be more attractive than DMC in profitable times. So think about 2014 when DMC's predecessor was unveiled, the MPP program. MPP was way out of the money when it first came out, way out. It wasn't attractive at all to speak of that first year or two. LGM would have been much more attractive because the margin conditions in the marketplace looked a whole lot better. DMC will be much more attractive in tight margin times. Think about like last year, for example, when I literally could have enrolled in DMC and knew I'd make money off the bat. So they're very different in nature in that sense. I want to take another 3 or 4 minutes here and just quickly give you an overview of futures and options. And again, this is probably going to be lower on your list of tools, but I want you to be aware of it. So from a producer milk perspective, there are 2 futures contracts that you want to be aware of that relate to fluid milk prices, or well, that relate to milk prices, I should say, class 3 and class 4. Both of these are settled based on USDA actual prices at the end of the month for those classes of milk. A futures contract for class 3 or class 4 milk is 200,000 pounds of milk, so it's 2,000 hundredweight. Now, as Ben said, I'm from just south of you all. I'm from Kentucky, so our dairies tend to be smaller on average than Ohio dairies, but that definitely limits a lot of the ability for a lot of my Kentucky dairies to utilize futures and options. And I suspect there's a lot of dairies in Ohio that are in the same boat. So kind of understand that's the kind of milk production level I've got to have on a monthly basis to really even think about using futures and options directly. They're available 24 months out, but there is a contract right now trading for November of 2022. But all dairy contracts are thinly traded, especially those far out there. So be really cautious about using those that are very far out. You're not going to see very much volume there at all. And understand, very much like what Mark talked about a couple weeks ago, your milk price is going to vary quite a bit from class 3 or class 4 milk, which is what those contracts are actually settled on. So this is what Dan and I talked about by email for the last couple of weeks, is what's the best way to kind of get a feel for basis. So again, black line and red line are just simply comparing Ohio blend price that Diane shared with me with class 3 futures. So this would be kind of like a basis for your blend price. And notice that it's been kind of in the ballpark of, from roughly 0 to about $1 hundredweight above class 3. And that's kind of a normal. Your milk check should be a bit better than the blend price. So kind of make that, in the back of your mind. You've probably got some premiums associated with your milk that probably bring it up a little bit. But again, think about what Mark talked about, and look at that, look at that 2020 line. There's a big difference there. And again, this is one of the risks, this basis risk. If your milk price doesn't move with class 3 and or class 4 milk futures, there is a concern about how well it's going to do protecting you from price risk. Typically, I think it works reasonably well, but 2020 has certainly been an outlier. So I'm not going to lie to you about what that looks like. This is very similar to what Mark showed with the Ohio all milk price a couple weeks ago. Quick example. If I want to hedge milk using futures, and I'm going to probably use class 3, for example, and I'm going to sell a class 3 futures contract for the month of milk production I want to cover. For example, that might be February 2021. Understand I'm selling February 21 milk futures because I'm worried that by February of next year, that the milk that I sell will be worth less. The idea is that if milk prices do drop, I've sold February 2021 milk futures. Prices drop, I've sold first, I make money on my futures contract, which offsets the fact that that milk that I'm going to sell in February is going to be worth less. And the reverse is also true. If prices go up, I'm going to lose on that futures position, which is going to be offset by the fact that the milk that I sell in February, however I sell it, should be worth more. That's the idea. I'm basically saying that these two things should move together, that being futures prices and what I actually sell my milk for in February. Another quick example that a lot of folks have used in the past, I can think about a put option. In other words, a put option is the right to sell. I've got the right to sell milk futures at a predetermined price. So maybe the February class 3 milk price is $16.50. Maybe I buy a put option with a $15.50 strike price. What that means is if milk futures between now and February drop below $15.50, then I can start to make money on that futures contract. Again, that will offset the fact that my milk is going to be worth less at that time. A couple things to point out. First of all, understand that if the futures market's at $16.50 and I buy a $15.50 strike, I have to self-insure that first dollar. That's like a deductible. So I have to self-insure the first dollar. Beyond that, though, I make money on my put option and I've got a price floor in place. And the nice thing is I can still benefit from rising prices. So those are kind of two quick examples of using futures. My final thoughts on both LGM and futures. So first of all, know the tools that are out there. Although I'm not discussing DMC or Dairy RP today, Chris and Jason have done and are going to do a good job with that. I think those are two excellent tools, so make sure you understand those. I also want you to know how futures and options and LGM work as well. They're also part of the toolbox you have access to. Understand that LGM is market-based. It's the only market-based margin program that's out there. You can customize the fee component unlike you can with DMC. So that is the advantage of it. Again, I don't think futures and options are going to fit with a lot of you that are listening today, but know that they're out there. At a bare minimum, know what milk futures say about price direction. They send a lot of market signals. They can also be a good way to evaluate forward pricing opportunities. If you've got the opportunity to forward price some milk for say first quarter of 2021, a really good way to start evaluating is look at first quarter's CME class 3 milk futures and see what kind of basis they're inherently offering you in that contract. So use it for those types of things. And then be aware that there's risk and potential for futures and options as well. Chris had this up earlier, I think, but I'll leave you with my contact information. Feel free to reach out to me by phone, although I'm only in the office about once a week right now. We're mostly working from home, so if you do call, leave me a message. My email, I can almost always get back to you within about 24 hours by email. If you're on Twitter, feel free to follow me at KY Cattle Econ. And again, thanks for the invite. I'll look forward to some question and answer.